Ladies and gentlemen, welcome back to the channel. Welcome back to our markets in which it seems like you cannot catch a break. Now, something big could be coming on the near-term horizon. Do you remember 1987 and Black Monday? Well, probably most of you don't. So if you don't, let me remind you what the chart looked like. And it looks like identically to right now. Like almost to a perfect 100% match. We're going to go ahead and get into that and much more here in this video. There is a lot we need to get into, and we're going to kick it off with Black Monday, or which could end up being Black Friday. I don't know. Black Fridays are typically good. Black Fridays in the markets, probably not so much. Hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comments section. Let's go ahead and jump straight into it. I want to start with what could be coming in our markets. Now, our markets today, S&P is down 1.55% at the time of recording this video. The Nasdaq just flushed to a new low, down 1.65%. As you can see, I am currently filming this video with about 30 minutes left of the trading day. So, it's a rough one out there. Okay, stocks are down big. Microsoft down 2.21%. Apple down 2.4%. Sheesh. That's rough. 1987. Let's break this down. So, this was 1987 and Black Monday. This candle specifically was Black Monday, where you fell about 20%. But even the subsequent 3 days or so heading into that period were also not great. You're also basically around the same period of time when Black Monday actually did occur. Black Monday was actually October 19th. You're September 26th today. So a little bit off as far as the dates, but not much. These charts look almost identical. Almost identical. This was actually taken, the screenshot, over the weekend. And if you really look close here, there is a green candle right here. You did bounce once you hit this low. And that's exactly what happened yesterday. Yesterday, you seen a bounce right here. Just like what you seen during the, 3 days before Black Monday. You got a bounce right here. And then you fell down lower. Just look at this. Down lower. Actually, we'll go ahead and hold on. Let me make it so I know you guys for sure can see this. Okay? We're going to snip this down. Okay. Let's blow this up for you. So, you bounced, this green candle was a bounce, and then you came down lower than the bounce, broke to a new low. What in the world is happening today? Huh? You gotta be kidding me. Look at it. You really can't make this up. Guys, this is like, hold on, let me see if I can move this a little bit. Didn't mean to do that. Look at this. You really can't make this up. You flushed down just like you did right here. What? What? It's the exact same formation on the charts. Now, history does not always repeat itself, but it usually does rhyme. And the rhyme is really starting to sound quite rhymey right now when you look at these charts side by side. So that's not great. It's not the greatest thing in the world. But take a look at this. So hedge funds added their biggest short exposure since 2020 this past week. This is coming specifically from fundamental long/short hedge funds. The short bear on Twitter says this is extremely out of the norm, and to me looks more like FOMO/panic. right here. This is much lower than even what you've seen during 2022 when people were freaking out. You're getting down to some of the same kind of levels that you were at during the crash of 2020. This is not a good sign, ladies and gentlemen. And in the grand scope of things, look at the markets compared to 2022. You are still, even after today, much higher than you were before. So there could still be quite the downside from here. It's not exactly the greatest thing in the world. Now, the short bear also shared this post. It says positioning in the NASDAQ 100 is now one-sided, net short at 8.1 billion with all long positions unwound. This is from Citibank. This is the NASDAQ 100 put option activity, and it is surging higher, the highest you have seen in a very long time. Very, very long time. You got to go back to one brief period before the start of 2022 to get a 1.7 put to call ratio. If you guys have been investors in AMC stock for a while, well, you've probably seen me pull up the put to call ratio. 1.7 is the put to call ratio here on the NASDAQ 100. That is where AMC stock has been since January of 2023, when AMC stock effectively went from these pre-split adjusted prices, went from about $50 down to $7. So when the put to call ratio is this high, now it's been falling recently with AMC, and that's a good thing, but when the put to call ratio is this high for the broader markets, it's usually not a great sign. Okay, just all of those puts alone can have a very negative downside pressure on the markets. Now, if you guys want to come trade this with me, come get access to all of the trades I make in real time, linked down below in the description of this video. I think things could get absolutely wild coming here over the next couple of days. This 1987 chart, Black Monday, is looking very, very similar to what we are seeing today. Again, you're probably not going to fall 20%. The markets are a lot different now than what they were in 1987. If something were to break, I don't know what it would be that would cause markets to fall that much. If a global pandemic did not cause 20% down move in a day, I think the only thing that could do that is like an alien invasion or a nuke went off or something along those lines. So nobody wants to see a down day of that degree because something really, really bad obviously happened. Okay, so I'm not hoping for that by any stretch of the imagination. Quite the opposite. But it just don't look good. Maybe to see a 3+% down day at some point this week. That could actually happen. That looks a little bit more reasonable to me as far as possibilities. So there is that. Now, the economic data that we're going to get is very important. You guys got to remember, the Fed made it very clear. Even if inflation comes down, they need to see a bad economy. So right now, the markets were not prepared to hear there was no win, period. What I mean by that is if inflation falls and comes back down to 2%, but the economy is doing well, then we're not going to get rate cuts. Okay, we're going to hold rates higher for longer, no rate cuts until something breaks. If something breaks and you get rate cuts, well, what good does that do if you're already in a recession? It's not great. So there's really no good outcome here. The markets were hoping for the Fed to acknowledge inflation's coming down and the Fed to slowly start cutting rates as inflation was going back down to 2%. The Fed said the opposite. The Fed said we're going to raise rates if the economy continues to hold up and continues to hold strength. That's a bad recipe for any economic data that we're going to get, because if you start to get a downturn in the economy, that's not good. It's not good for your stocks. That's not good for the economy. That's not good for companies, but it might be good for potentially emergency rate cuts. I do think emergency rate cuts are coming. Since 1900, only one president has won a re-election if that re-election has been during a recession, and that was William McKinley. Since then, 4 presidents who ran for a second term during such an economic downturn, William Taft in 1912, Herbert Hoover in 1932, Jimmy Carter in 1980, and George W. Bush in 1992, were unsuccessful. People vote with their pocketbooks. People vote based on what the economy is doing. People vote on how their jobs are doing. If they're unemployed, you're a lot less likely to vote for the current president. Okay, I think that's pretty straightforward. So I think if you do start to get a sharp kind of economic downturn, markets, they're going to get unhappy, and they're going to get unhappy very quickly, and the Fed is going to need to cut rates at that point. They will be highly influenced, odds are, by the government, by that statistic I just mentioned. Now, Jamie Dimon warns that the Fed could still raise interest rates sharply from here. JP Morgan's Chase CEO Jamie Dimon is warning that interest rates could go up quite a bit further as policymakers face the prospects of elevated inflation and slow growth. Quote, "I am not sure if the world is prepared for 7%, he told the Times of India in an interview. The comments came less than a week after Fed officials indicated they could approve another quarter-point increase before beginning to cut a few times in 2024. Jamie Dimon says, quote, "I'm not sure if the world is prepared for 7%, he said. According to a transcript of the interview, I asked people in business, are you prepared for something like 7%? The worst case is 7% with stagflation. If they are going to have lower volumes and higher rates, there will be stress in the system. We urge our clients to be prepared for that kind of stress." Well, that doesn't sound good. He says, quote, "I would be cautious," Dimon told the Times. "We have to deal with all of these serious issues over time, and your deficits can't continue forever. So rates may go up more, but I hope and pray there is a soft landing." Yeah, it doesn't sound very good. Doesn't sound like a good thing from Jamie Dimon over here. So there you have that. I think that was also pretty important to point out. Now, you are seeing a spike in oil again today. Oil is up about 1%. Oil has risen from $69 a barrel to almost $91 a barrel. This is a 35+% rise in crude. This has always been right before a recession. You have seen a spike in oil since 1945. For one reason or another, you always get a spike in oil before a recession. So that is kind of maybe saying, hey, this is the spike. Maybe we are going into a recession. Now, if you look at the 10-year Treasury, that is up about 1.5 basis points. The 2-year Treasury is basically flat on the day. That means the yield curve is continuing to uninvert today. If you look at the 10 and the 2-year yield curve inversion, you're not going to see today's uninversion reflective here. It's probably going to move up 1 basis point or so. But right here, you are inverted 0.54%. It's actually when you start to uninvert is when you see the pain in the markets. When you start to uninvert, that is right before you head into an actual recession. So that is not great. You also have the 10-year and 3-month yield curve inversion, which is rapidly steepening. Now only inverted 1.03%. At the lows, you were inverted 1.88%. So when you start to uninvert, that typically moves in a straight-ish line, and it tends to go pretty fast right before you actually do go into a recession. So you could be on the brink of going into this actual recession. Now, the data coming out over the next couple of days will be very important. Durable goods orders coming out tomorrow at 8:30 a.m. is going to give us the first glimpse of what the data looks like for August, the last month in Q3. Well, the second month in Q3. July's data was pretty good. So you do have GDP estimates on Wall Street about 3% for Q2. Well, now you're starting to get all of your August data coming out. If August data looks bad, well, you might see dramatic reductions to the GDP estimates, and this could be very negative for our markets. If we're expecting 3% right now, but this August data starts to look really bad, we might see the estimates come down to 1.5%. If you see a 50% reduction in GDP estimates, the markets are going to say, whoa, a recession is a lot closer than we previously thought, and that could be a black swan event for our markets. This is something I've talked about many times now. It's not a big shocker. Black swan event could be GDP coming in a lot worse than expectations, but really the GDP estimates get influenced and affected by the data that does come out. And if we were to get really bad data tomorrow for durable goods orders, we're expecting negative 1.4% as the forecast. Last month's reading was negative 5.2%. If you come in at like negative 10% or something, yeah, that would be a really, really bad day for the markets. Really, really bad day for the markets. Now, Thursday, you're going to get a speech from Fed Jerome Powell. You are also going to get Q2 GDP numbers that are finalized, as well as initial jobless claims. And Fed Goldsby also does speak. Fed Jerome Powell speaks at 4 p.m., so right after the bell. And then on Friday, you are going to get personal spending for August, personal income for August, as well as PCE price index. So that's very important to also remember. It's going to be a lot of big data coming on Friday. So Wednesday, Thursday, and Friday, yeah, could get quite insane. So that's very important to keep in mind, guys. So not great as far as AMC stock. Again, my same thesis remains. AMC stock on a risk to reward basis, it looks a lot, how do I put this? Your risk to reward being short in AMC does not make a lot of sense here, given the stock has fallen so much. Fiscal year 2023 ends this Friday, so you're likely to get quite a bit of short covering, hedging, potential buying of AMC heading into the end of fiscal year 2023. 2024, it looks a lot better to be long in AMC rather than to be short. But again, if we do have some kind of black swan event in our markets, that would obviously be a very negative thing for the markets. And I doubt that would be a positive for AMC, regardless of anything else. So that is going to do it for this video. As far as the other data with AMC, the Ortex data, things of that nature, it's exactly the same. So go ahead and watch the last video if that is something you guys would want to see again. The numbers have not changed literally at all. And I think this information was a lot more important to get out to you. Again, if you guys want to come trade with me, link down below in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.